PepsiCo Inc. ticker symbol PEP is currently trading at $175.13 a share. Over the last year, the stock is up almost 8%, has been pretty turbulent times. A 52-week high of around about $85 a share and the low at around about 157. What we're going to be doing today is talking about the stock, taking you to my automated stock valuation spreadsheet, looking at details about the stock, looking at the financials, and then giving my intrinsic value of the stock using discounted free cash flow model, the Ben Graham formula, and the comparables companies model analysis. So we did a video a few days ago on Coca-Cola, and I did notice that the ratios between Coke and Pepsi were looking pretty favorable for Pepsi. So what I'm going to do is I'm going to value the stock. As you can see here, over the last year, it is $175. If we take this to the last 5 years, it is up 64%. Now, what I'm going to do is I'm firstly going to compare it to the S&P 500 to see what it is against that. Now, if we look over the last 5 years, you can see that Pepsi is actually beating the market 65 compared to 51. If we bring the time frame a bit lower, Pepsi's up over the last year, S&P 500 is down. So it is beating the market. Now, if we compare it to Coke over the last year, Coke was flat and Coke was flat, Jesus. And now Pepsi is around about 8% up. Now, if we go 5 years, this is a more telling picture, beating Coke by about 20%, 64 to 42. And if we go all time, now not a very fair estimate, but you can see Pepsi up until about 2013, whereas Coke was winning. Now Pepsi has gone on a bit of a run. So is Pepsi the better buy? Obviously Coke has its advantages, higher dividend, but that's what we'll look at today. First, we'll look at my stock valuation spreadsheet. So let's type in Pepsi. What this will do is we'll load all the company financials from Google and the API. And you can see here it has a market cap of 241 billion, price of 157, P ratio 27, a little bit higher than the market. We would like that lower. Earnings per share of $6.49 a share, beta at 0.53. So it is much less volatile than the market. Dividend yield, 2.63%. Coke had about a 3% dividend, so it is a lot lower. Dividend per share, $4.60 a year. The total dividend, 6.3 billion. Now you can see here these payout ratios are on the higher side. Net income is 71%, so that is touching the higher side. We want that really to be low 75. But free cash flow payout ratio is over 100%. So that is actually an unsustainable dividend as per the free cash flow payout ratio, which is why a lot of people do prefer Coke because of that safety. Ex-dividend date is the 2nd of June, so buy before then. Before I go on, please like the video and subscribe if you're not already, and also check out my Patreon. Link is in the description. We have a couple of offerings here, but this is the sheet we're looking at, which is the automated spreadsheet. Revenue, is the revenue increasing? Yes, 64, 67, 70 was not hit too hard by the pandemic compared to Coke, 79 and 86.4. So this is record-breaking revenue for Pepsi. Net income though, interesting story, 12.5 to a few years of 7 to 9 billion. So they're able to generate 12.5 billion out of 64 billion in revenue, and now their net income margins are a lot lower. So that is very interesting. We'll have a look at the numbers and see what it is in a sec. Shares outstanding, are they buying back their shares? Are they issuing more shares? Well, you can see they are very slowly buying back their shares, apart from a little run up here. That could be some rounding errors here, but you can see more consistently it is on the way down. We like that obviously because they're rewarding shareholders for buying their stock. And finally, free cash flow. What's it doing? Well, 6.1, 5.7, 6.4, 7 billion in 2021. And then down to 5.6. And as we said, this means that the free cash flow payout ratio is on the high side. So free cash flow is down this time in 2018. So I don't think when we look at the discounted free cash flow model, is it going to like the stock? Well, interestingly enough, let's see if the numbers are okay. Yes, and it has a calculated stock price of 190. So this is looking at the future free cash flows and discounting them to today's value. Let's have a look. Those free cash flow numbers are a bit higher than what we're expecting. So let's have a look at the revenue growth first. We've got an average of about 4%. Let's have a look and see what analysts are expecting. See if we're in line with that. They're expecting around 90 and 94 billion. So if you look here, we are pretty much dead on there with our estimate. So they're expecting about that growth rate as well. So I'm happy with the revenue. Next, net income margins. Well, you can see it's all over the place. And in fact, what I'm going to do is I'm going to bring this down a little bit to an average of there, because it looks like 2018 was a fantastic year for the company. So let's go down to 10%. And that's the difference right there. That takes us from $190 stock, oops, wrong button, to a $50 stock. Let's take a fair average. We'll look at the final year of $162. And finally, the free cash flow to net income. Well, this number is a little bit out of whack because of the 2018 number. So we are going to take an average of that, which is about 79%. So based on discounted free cash flow analysis, after all that, the stock is fairly valued based on that. So that is very interesting to see. Next, we'll have a look at the Graham's model. What this is Ben Graham's formula, the father of value investing, and it's a formula for evaluating growth stocks. What it is, earnings per share compared to a PE of a no-growth company, the growth, the average corporate bond, and the current corporate bond. Current corporate bond is 4.56. And if we have a look at analyst estimates again, I would love to automate this. I just don't think I can. The previous next 5 years is 7.55%. So we've already got that number actually in here. And based on that, the stock is overvalued. $90 a share is what Ben Graham would put the stock at. So if we go back to the share price, when was the last time Pepsi was a $90 stock? Got to go back all the way to the pandemic, even before then. So pre-pandemic prices is what Ben Graham would buy it at. So Graham's model does not like it. Now we go to the final one, which is the comparable companies model. What this does is it looks at similar companies that we will provide using those metrics. The metrics are EV to revenue, EV to EBITDA, which is earnings before interest, taxes, depreciation, amortization, and then finally PE. So we've got Pepsi here, we've got the ratios. So firstly, let's put in Coke. The other companies I was doing was Keurig, Dr. Pepper. We're using the same companies as the video as I did the other day, and Monster, which is Monster, is that right? Nope, okay, I got the ticker wrong. Monster ticker is MNST. MNSR, God, so close yet so far. MNST. And as you can see, it's pulled through all the data. It's pulled it from the Google Finance and the API I use, and it gave us the revenues, the metrics here. What we want is lower numbers. EV to revenue, Pepsi is the lowest. EV to EBITDA, Pepsi is the lowest. And P ratio on these companies are the lowest. So based on averages, if Pepsi was averaged at Coke, Keurig, and Monster's market valuations, you can see that this would actually give it a share price of, based on EV to revenue, $342 a share, EV to EBITDA at 191, and PE at 219. So that is $250 a share. So now these are a little bit different, so I'm going to just compare it directly to Coke. Yeah, there you go. So based on if it was valued the same as Coke, the implied share price would be $304 in terms of EV to revenue because of that much lower EV to revenue. EV to EBITDA, about fairly valued. I'm surprised it's that, but you can see it's $170 a stock, a share. And then P ratio 178. So overall, if you take more stock in the EV to revenue, it will be $218 stock based on these averages. But once again, looking about fairly valued. So Coke was overvalued, I believe, in the previous estimates. And now they're saying Pepsi is maybe a little bit undervalued. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon for my stock valuation sheets. And yeah, subscribe, as I said before. So I'll catch you guys next time.